Greetings,
There
Ian.
he is. Yeah, what
How
a
are you?
pleasure, David. What a pleasure. I forgot how handsome. I forgot about
Pleasure is
that.
all mine. All mine.
Yeah. Well, great. So it's great to have you, and I'm going to let you introduce your panel.
Okay. I will do that right now. So the panel is called Peak Performance for the Self-Storage Asset Class. And I want to thank the public companies for reporting their results in such grand fashion in anticipation of our panels today, because I think that sets the table rather nicely for what we'll be discussing with our panelists. The panelists are Steve Treadwell, who is the CEO of SpareBox Storage, Shawn Hill, principal and founding member, Kenneth Cox, executive managing director of Newmark. I think you've changed your company name again. And Scott Levy, executive vice president of investments for Simply Self Storage. So I'd like to use the recent reporting of all the public companies as kind of the backdrop for where we find ourselves as an industry, which is that basically we're at historical highs in all relevant metrics. And that affects everybody's business in terms of competitiveness for deals, attractiveness of financing, desirability of capital entering the space, and a general frothy, robust environment. So with that as background, I would like to start by posing a question to the group as a whole, as follows. As the self-storage asset class reaches new heights of both performance and recognition in the investment world, especially relative to other real estate asset classes, from the perspective of your company, what is driving these outstanding results? And Steve, we'll start with you. You're an active private participant in the market, looking to grow your company. And you're operating in a context where the market is essentially on fire. So what do you think is driving those results, and how are you dealing with it?
You're on mute.
Steve, you're on mute. But I'm sure it was awesome.
It was incredible. Sorry. I'll try to repeat. Thank you for letting me know. All right. So I think there are, two really big dynamics at play here. The first is that there's been a secular shift in demand that we did not foresee 2 years ago as an industry and as a group of operators. Some of that is this work from home dynamic that has not gone away. It seems to persist. Some of that is economic. You've just got the economy coming back and more household formation, more discretionary spending. So folks have more dollars to spend on storage and more reasons to store. And you've got a generational shift. You got the Gen Zers and the millennials both pushing into storage as new users. And then you got the boomers who are downsizing. So all three of those big generations are out there adding to their sort of net storage needs. So that's been great for all of us as operators. So more demand. And then what we've also found is, frankly, that pricing is more robust and stickier than we ever thought. We didn't realize how hard and how far we could push our customers on pricing as operators. And I think we learned over the last 2 years that they would take a lot more price increases than anybody ever suspected. So those two things together are driving revenue growth and driving NOI growth. And, it's up to us as operators to find great opportunities to leverage that. So we at SpareBox are looking for the right markets and looking for the right stabilized properties where we can leverage those two dynamics and generate some returns for our investors. So that's our perspective. I'll pass the baton to somebody else.
Shawn, what are you seeing?
Well, I think Steve did a really nice job of summing it up, but I would, we generally look at things from the capital markets perspective. We're in the debt and equity business. And, from that perspective, I would say it has a lot to do with, I wouldn't say a lack of alternatives, but I think that this industry continues to look really good against the alternatives that exist in the market. So if you look at, again, the pandemic proved the resilience of the industry. And I think there's just a tremendous demand for exposure to the property type. So whether you're talking about a lender or an institutional capital source or just about anywhere on the spectrum, people have really woken up and realized that they need exposure into this asset class, that it's, an outstanding place to put money. And I think that's reflected in the market.
Mhm. Okay. Sean comes at this from the perspective of financing on the debt side. Kenneth, your brokerage practice has to do with primarily institutional portfolios. How are you experiencing the uptick in the market to historic highs?
Yeah, I think Sean touched on it, and that everything Steve said is why we're seeing so much interest in the sector. There's been a lot of private equity that have joined the fund over the last 8 years, but even more so over the last 24 months, the last 18 months. You've got very large groups that frankly probably can't even move the needle in their fund structure in self-storage, right? I mean, it's tough to deploy enough capital that some of these groups need to do, but it's for lack of a better term, it's just kind of in vogue right now, and I think to be in storage, and I think it's proven its resiliency over the years through challenging times, which it did again during the pandemic. So I think it goes back to the operating fundamentals and how we compare to the other sectors kind of during the pandemic. It's just once again outperformed, and so some of the folks that were on the fence are now jumping in the middle of it, and then those that have been in are just doubling down.
Okay. Scott, I'm going to change it up a bit before we get to you, which is that now that we've established that we're not only at historic highs, but relative to other real estate asset classes, self-storage is very well perceived these days. So with capital rushing into the sector from all sides, private, primarily through private equity, the public companies have access to capital, obviously, and as well, there's new players entering the industry seemingly every week. So when a deal comes to market, or you're made aware of a deal, if it's not widely marketed, or perhaps it is, how on earth do you compete with all of this capital that's rushed into the sector and come away with a successful deal?
I've determined at this point that good looks and wit will only get you so far. And I've pretty much exhausted both of those a long time ago. So, I mean, realistically, everything that the other gentleman on the panel said is extremely important, because all of that fed into the amount of folks that are looking to get into our space. It's the folks that are looking to cycle out from enclosed malls, and now they have a corporate allocation that they need to put somewhere. And storage is the darling of the ball right now, and we're all seeing that. And shoot, the operating fundamentals support that as well. I mean, for us, when we're looking at trying to do transactions, we want to be the buyer of choice, and I think that you do that in a multitude of ways. I think that you obviously can be competitive when it comes from a pricing perspective, but I think you also can be competitive, and we are competitive as it relates to terms. I think that we try to think outside the box and try and really address what I think the seller's needs can be, or what seller's needs are. So it's not just a transaction for Simply, but it's a transaction for both parties, and how do both parties walk away feeling like it was the best opportunity for them. For me specifically, I'm a big believer in getting rid of problems before they occur. So on the diligence side, where usually when elbows get a little bit pointier and tensions get a little bit higher, how do you see problems that happen before they come, so that by the time you're talking to the seller about something, you've vetted out all the potential concerns, all the potential opportunities, or in many cases, the seller never even knows about it because you just make the problem go away. And I think that when you do that and the seller is aware that you were able to do that, it makes the seller's job easier, and then ideally creates a comfortable and fair transactional environment. And we are fortunate in this business because we are all such good friends, as Kyle and Ian mentioned earlier, that a lot of our business is repeat business, and people want to do deals with folks they're comfortable with. And I think if you can prove out, as we have in the past, that we're gonna work hard to try and make a deal work, and we're gonna do what we say and say what we do, I think that goes a long way within the industry, and I think that's the best way at this point in the environment that we're in right now to be able to set yourself aside. And on the Simply side, it certainly has worked well for us, and I would expect to continue to do so as we look to continue to grow the portfolio.
Okay. Steve, I think the same question is applicable to you as a private operator out there competing with many players and capital sources to win deals, which you've been quite successful at recently, as has Scott. What is your secret sauce?
Yeah, it's certainly challenging out there for all the reasons that Scott mentioned. We have been successful at frankly staying away from marketed deals, and staying away as a relative term. I think probably half of our deals are marketed and half are off market. And it's incredibly important to us to find those good off market deals, because we cannot win on a pricing competition. We just don't have the cheap capital to win those contests. So we're looking at, frankly, markets where maybe some of the institutional players are not looking. And we're trying to turn over enough rocks to source those off market deals that others don't know about. So that's been a key to our success when it comes to the marketed deals. Like Scott said, we want to be a good buyer. We want to have a good reputation, and I think we do. And I think our broker friends out there in the world realize that we are a good buyer. We are closers, so that's important. But we're also able to buy things that maybe others are not, things that make sense for our portfolio that don't make sense to others. Sometimes that's a size question, where we can go down and do a 40,000 square foot store that makes sense for our geographic clustering, but it may not make sense for anybody else. Or we can take on a store where, frankly, unmanned has an advantage over manned type of operation. So that tends to exclude some of the more institutional operators. So we're trying to find those places where we can have an advantage, because we cannot compete consistently on price.
Okay. Sean, moving right along. With credit relatively easy, and you're on mute, by the way, and our product in favor in the marketplace, explain the current landscape for debt for storage and what you consider to be the most attractive debt products that are available today for both acquisitions and for development.
Yeah, well, first, let me say that people have been trying to mute me forever, so I was just doing everybody a favor by trying to give them what they've been asking for. But
yeah, I would like to extend my personal thanks.
You're welcome. Look, the capital markets right now are flush. There is capital just coming from everywhere. What we are seeing is sort of a perfect storm. I could talk about just almost any product type that exists in the financing landscape, but we have been doing a ton of CMBS right now. And I think it's a perfect storm of where interest rates are and where cap rates are, and whether or not an owner chooses that it's the right time to exit. And if they choose not to exit, they have an incredible opportunity in front of them to take equity out of their deals and, frankly, change their entire business. And as one client recently told me, my entire life. And I'll just tell you a couple of transactions that we worked on recently that I think are really sort of mind blowing. And one is a refinance of a property that we did for a client in a secondary market. This is the third time that we financed that property. The client built the property with hard money, 14% money 20 years ago. 7 years ago, we put a new CMBS loan on the property. And at that time, the property appraised for about 10 million bucks. And we put a $5.8 million loan on the property. We just refinanced that property for $13 million. The property appraised for $21 million, and we put $6.5 million of cash in the bank account of the client, and his payment changed by $100.
Wow.
$100 delta in the payment that he was making to the payment that he's now making after paying $1.5 million to defease the loan. We did another transaction for a client in suburban Michigan, and that client was not interested in taking a bunch of cash out. He just wanted to reset his debt. So we did a rate and term refinance on the property, and we gave him, in his words, a $17,000 a month raise, over $200,000 a year, over $2 million over the life of the loan, by just simply doing a rate and term refinance. And that's not because the BSC group has some magic trick in their back pocket. It's, when you put somebody into sub 3%, 10-year full term interest only money, it's amazing what it'll do for your cash flow. But in those cases, in neither of those cases were those high leverage transactions. If you think about it, 13 million on a $21 million value, or 5 million on a $10 million value, those are 50% leverage deals. So there's really no reason to amortize the debt. You're already sort of have amortized the debt going in. So you can take advantage of this full term interest only money, which the rating agencies ironically are favoring pricing on. So for low leverage deals in the CMBS market right now, you can obtain better pricing by taking full term IO money than you can by amortizing the debt. So, we can sit here and bank debt's incredibly cheap. The SBA found a foothold, into this industry and is lending money actively. Credit unions, insurance companies, now that the transactions have gotten bigger, really the insurance company money has started to come into the space, because the real problem that insurance companies had for the longest time was they just couldn't write a big enough check. But pretty much every facility in the country, if they've had good rent growth over the last 7 years with 250 basis points of cap rate compression, have doubled in value. So, if you're not a seller, and, I know that I've got a bunch of buyers and sellers on the line, but our client, if we're not doing acquisition financing for them, a lot of times is, how do I take advantage of what I've got right here in front of me? And, the client, we put, all that cash in his bank account. We have several clients that are actively doing either estate planning and or reloading. It's all about recycling capital. So they're looking at the next 10 years and saying, where are the opportunities going to come? Right now, I can position myself to be flush and really have an advantage in the market going forward with all this capital. And, oh, by the way, my payment is not going to change or is going to go down in a lot of these situations. So it's just a perfect storm in the market to take advantage of what's in front of you.
So you don't favor one particular product at the moment? It's really tailor-made to the situation of the
Yeah,
borrower?
well, so much, David, of what we get, every deal is different, right? So one day it's, if the client's coming to us just saying, look, this is a stable facility and I want to optimize my debt package, that's a very different assignment than, hey, I want to buy a property at C of O, or hey, I want to build a property, or, so depending on, where the client is coming from, a big part of our business is that sort of financial advisory component. It's trying to figure out, how do we position you for success today? And then how do we position you for success tomorrow? So a lot of times it's, there can be a multi-step approach. We may be putting a particular debt package in place today with the intent of refinancing that in the relatively short term after the buyer or owner executes a portion of their business plan. So it really is not a one-size-fits-all approach. But if you're asking me my favorite product type right now, CMBS is in the money if you are a long-term holder of your asset. There's just no doubt about it.
Okay. Now to take another perspective on our robust market here, Kenneth, one of your main pursuits is institutional portfolio transactions. This active and high performing market, how is it affecting your business, and how do you go about winning deals when other aspect of our industry, there's new players coming in wanting to have a piece of the pie?
Mm-hmm. Well, no question. Aaron and I, my partner, have seen a lot of new competition come in with, I guess, what's happening within the market. I mean, I think that we're expected as a sector to close somewhere between 17 and $20 billion of self-storage in the sector, and so that obviously brings a lot of folks in. Aaron and I both, and I'm not going to do a commercial like Scott SHAWN, but Aaron and I have been in the business a long time. We've seen the ups and the downs. We've seen all the cycles. We're obviously in a pretty strong cycle, and have been, arguably, other 2013, right, and then a couple dips. So, look, there are a lot of deals out there. We tend to gravitate towards the larger portfolios, typically institutional. I think the bigger question right now is, seeing close to $20 billion worth of transactions, and we're trying to figure out 2022. If you were going to sell, your mid-sized, a small operator, and you're not a 5-year holder, were you in the market this year? And I think the answer is probably yes. We know of some of the private equity firms that accelerated their horizon on some funds and have gone to market. We're trying to figure out 2022. I mean, look, it's a very fragmented sector. We all know that. We're trying to figure out, can we repeat or even come close to repeating next year? The demand, we believe, is going to be there. But will the supply, and that's supply meaning deals coming to the market, and how is that going to affect, cap rates? And because I think one of the, believe it or not, I mean, I think I read Green Street said that self-storage kind of price per pound's up 35 to 40% from pre-pandemic, which I believe. But believe it or not, I think that there was an aspect in the market this year that actually kept it from getting more aggressive, and it was just so many deals were out there. I can't tell you how many times we heard, well, I think even to use Scott's words, I believe it was, that we like that deal, but we don't love it, and we only have time to work on things that we love, right? So, the bandwidth across the buyer pool was stretched, and so we didn't, we probably didn't receive as many offers as we normally would have pre-pandemic on a deal, but they were higher, and net it was good for the buyer, and so what we're trying to figure out is in 2022, will that supply come to the market, and is there enough supply out there to come to the market? Now, what we know is, the private equity firm, and talking about institutional portfolios, well, look, every year they're going to look at their portfolio, try to maybe recognize gains. And certainly there are some other merchant developers that aren't really ready to sell yet. So that certainly will be supply next year in the market, but we're very curious to know if it's going to be enough to meet the demand, and then ultimately what happens, with the metrics and cap rates and things like that.
That's very interesting, and I'll bring up a couple of questions later about the possibility of a new round of deceleration, which seems inevitable, and a possible new kind of newly charged round of development in the wake of all this high performance. But I'll get to that in a little bit. I want to bring our friend Scott back into this and just ask if for you to give away some trade secrets about what your favorite target markets are at the moment. And I'm going to ask Steve the same question.
Sure. We are because of the size of our portfolio now and where we are spread out throughout the country, we are somewhat agnostic market-wise. That said, we do like certain markets better. We are focused on more growth markets. So I think if you think about, generally speaking, coastal markets and then across the South and the Southeast, that makes a lot more sense to us, where you see those being in migration states versus maybe some of the states or some markets that are more out migration states like Ohio. But generally speaking, we've seen good transaction velocity and good transaction volume in many of the markets that we want to be in. But I mean, for us, it's if the deal comes in California or the deal comes in Florida, we're gonna pursue them both. And as I did mention to Kenneth, and Kenneth was right in quoting me on that, we're gonna find the ones that we love the most. And that's what we're gonna spend the time on, because when there's this many deals that are in the market, you do need to be a little bit more selective and take the ones that you think make the most amount of sense for you in terms of return requirements and in terms of portfolio construct.
Okay. That was both informative and evasive. And I'm wondering, Steve, if you have any more specifics, or if you just want to tell us what your criteria are. I learned a lot from listening to you last time explain how you are willing to go after deals that may not be generally desirable in the marketplace because they fit one of your niches. And I'm wondering if that also applies to geography.
Yeah, we're very focused on getting the geography right. So we want to be thoughtful about migration dynamics. Scott mentioned that we're believers that is a long-term trend that we want to get ahead of. We don't want to fly in the face of it. So for us, I've been very vocal in saying that I'm not going for anything on the West Coast for a lot of reasons, but migration patterns being one of them. Similarly, we're generally staying away from the Northeast. We do have a New Hampshire portfolio, and I do like New Hampshire, and I would go there again if I could find the right deal at the right price. But in general, the Northeast is off our map. We're focused on the Southeast and the Southwest. We do like smaller markets, secondary and tertiary markets. We're one of those outliers who loved Amarillo before Amarillo was cool, and maybe it's still not cool, but it's been great for us. We like Central Texas to include Waco and Austin and probably others that we will find along the way. So we're focused on that. We're trying to dip our toe into places like Dallas and Houston, but haven't found the right deals yet. We like College Station. I would like to find something in Alabama or Georgia, but haven't found the right deals yet. We do love the Pensacola / Panhandle portions of Florida. I also like Central Florida, sort of north of Orlando, but we haven't found a deal there yet. And we're just starting to dip our toe into South Carolina, Western South Carolina, sort of Greenville, Spartanburg area. So we like that. And these are, largely secondary and tertiary markets that have been maybe underloved by institutions, not completely overlooked, but just maybe underloved. And so that gives us maybe an angle to get deals where we might not be able to in a Dallas or Houston. And then another example of that would be Northwest Arkansas, where we've spent quite a bit of capital so far, and we have a few more deals lined up before year-end that we're excited about. So we're trying to find those markets that make sense for us and for our investor, and maybe make a little bit less sense for the larger institutions. Maybe they're not trophy assets, maybe they're not trophy markets, but the cash flow wonderfully and the customers like them. So those are the types of assets that we've been focused on.
That, I believe, is a sound strategy and sounds vaguely familiar from my past.
We hear Sunbelt quite a bit from the buyer pool, and I think I heard Sunbelt from these two as well. If you read through all that,
Yep.
You hear Sunbelt as desirable targets?
Yeah.
Yes, but Steve is saying excluding West Coast, or the portion of the West Coast that's in the Sunbelt. But understood. Okay, Sean, the mute button is working very hard to keep you down, but I'd like to open this back up right now. Again, Sean and Kenneth in particular, you guys are market-wide participants. And first, I want to say to the audience, if you have questions, send them along in the chat that's available to you, and they will appear somewhere on my screen, and we'll try and get to them. Meanwhile, I'd like to, Sean and Kenneth, ask you guys to comment on whether the robust market performance is going to kind of recharge the development cycle, which I think was seen as being in the bottom of the seventh or in the eighth inning when the pandemic hit. And the next question I'll ask after that is whether the strong performance of the public company is going to lead to a new round of discussions about deceleration and how strong performance is going to drag down stock prices because extra strong performance has been the rule of the day. And if it just kind of reverts to the norm, are people going to be punished for something that doesn't seem to make any sense as long as performance can? So let's start with the development piece of that and whether you see current strong performance leading to a newly invigorated development cycle in the coming months and in the near term.
I'll let you kick it off, Sean.
Yeah, okay. Well, what I would say to that is, human nature is to screw it up, and we're going to try. So, yes, absolutely, it is creating a new development cycle. All you have to do is pull up your LinkedIn if you're plugged into any self-storage groups, and it's new development after new development after new development. And I think that what we saw was right before the pandemic, there were a lot of people that were crapping their pants. That's a technical term. And they were very concerned that they had overbuilt. Rents were softening. Properties were taking a long time to leasing up. There were a lot of funds sitting on the sideline gathering capital to buy distressed assets. And then the pandemic came and healed everything. God bless self-storage. And everybody forgot about their moment of running to the bathroom and decided this is the greatest thing ever. We're going to make a lot of money. We're just going to do it again times 10. So, I'm a little bit of a contrarian. I mean, I just feel like I don't know how much better it can get. You're looking at, the Fed's talking about tapering. So you've got a potential taper tantrum on the horizon. We've got inflation. We've got a supply chain issues. So everything costs more. Land prices are up. It costs an enormous amount to develop. All these deals that are being built around pro formas that are leaning into rents and leaning into occupancies. And, if you lean too far, you fall over. And that's the problem that I'm worried about. I mean, I really love this industry and I really want us to try to figure out how to grow in a sustainable way. But when you see the performance of the REITs and the performance of the sector, I don't blame people for wanting to go there, but it's very concerning. I recently read, and anybody that knows me knows that I don't have a lot of original thoughts. I just plagiarize other really smart people and then try to look smart. And there's a Wall Street analyst named Ivy Zellman. If you're not familiar with her, look her up. But she called the top of the housing market in 2005, 3 years before Lehman Brothers collapsed. And she's calling it again right now. She just put out a new report called Cradle to Grave. She basically says that home builders are overbuilding right now, that demographic trends are moving against us. It's a demographic business, everybody knows. And if you read her report and you didn't know that she was talking about home building, you might think that she was talking about self-storage, because what she's talking about is how much it costs to build, how buyers are going to, at some point with rates coming up, are going to not have as much buying power, and the homes are too expensive, and the market is being skewed by publicly traded companies that are buying single family housing for rent. or the apartment market, which is backed up by Fannie and Freddie and HUD. You know, people like to try to compare self-storage to housing, but at the end of the day, you need a place to live. You don't need a place to store your stuff. You can at some point decide you're just going to throw it in the garbage if it gets too expensive. And so, you know, I'm concerned because these facilities are being built around economics that I don't know if they're sustainable. And so, you know, I hope I'm wrong, and I'd love to be wrong, but I would tell you that I'm nervous about it. So,
Okay. Well, I think it's valid. I think it's a valid concern. And, you know, because when times are as good as they are, sustaining them becomes in and of its own right something that would be precedent breaking.
there's only one place to go, down.
Yeah.
But not all development's bad though, right? I mean, like we need
Scott,
to have.
are you guys considering restarting development?
We've had conversations about it many times since I've been here, and I think that it's just another avenue on the table of a way, or another arrow in the quiver to try and get capital out the door. I think that look, I think I've always been a proponent for smart development. I think that when you have three people that rush into one sub-market that's growing 5 years from now in suburban Charlotte, and everyone's building there, and it tanks rate, I think that that's inherently bad. But I think when you pick a smart undersupplied market and they're able to make a deal work, I think that's good for the market, and I think it's good for growth. For me, I think, and Sean, not to pick on your clients, but I think that, you know, some of that comes down to just lenders as well. And when the lenders are lending on the deal that's at the end of the cul-de-sac next to the train tracks with no visibility, because they believe some pro forma that says that those rates are the same as the property that's on the corner of Main and Main, I think that's what starts some of that pain as well. But I agree with you that I'm a little bit nervous about some of the development that could be coming down the pike. But I also want to say that I think some development is good development in growth markets where it makes sense.
I think there'll be a couple of constraints on development. One is the aforementioned land prices is going to make it tougher, but that gets to the problem that Sean mentioned, which is the flexibility people seem to have in their pro formas and how they're stretching things. And then the other would be that lenders may, you know, be as extended as they want to be on development and construction. So that could be one, you know, another constraint that could hold things back. But I think there's validity to the concern. Kenneth, did you want to say anything about development? And then I have a question coming in from the audience.
I mean, look, I think Sean covered it pretty well. You know, our hope is that some of the headwinds that are there with inflation and you know, land costs and everything like that tempers the, you know, development that's done in markets that shouldn't. I mean, we live in a radius, right? Whether it's in the boroughs where it's you count it in blocks, or in Oklahoma City where it's 5 miles, and so we always felt like there are opportunities to develop, and you know, as long as we're more diligent than sometimes we've been in the past, which I actually think some of the guys that maybe, I believe you crapped in their pants, or were crapping in their pants, I forgot how that was phrased.
We can put that metaphor to bed now. We can flush that metaphor, Kenneth.
Okay. I do hope that some of those groups do recognize where they were for, you know, 2 years and 3 years, because we talked to a lot of them in 17, 18, and 19. And, you know, at that time, it could have been, hey, get out with a single, maybe a double, but many wanted the home run, and timing worked out. And so it did work out for many folks. But I guess we have short memories, like Sean pointed out. So hopefully it'll be a little bit more diligent as we kind of continue to develop.
Okay. We have a question from the audience that I'm going to put up for grabs, which is, on the development side, do you ever see mixed use projects paired with self-storage? my short answer to that would be only when the municipalities make you do that, or usually only when municipalities make you do that. And then the rest of the question is, which I'll throw out there, if so, which asset classes make the best case to mix with storage if it is a mixed use development? Anybody?
Retail.
Yeah, I would agree with that. I mean, it's probably going to be a zoning issue that's going to force the hand on that. So, you know, the municipality is looking for sales tax. They're not going to put, you know, an office building in with a self-storage facility. They're going to put something that's complementary to, you know, a coffee shop, a UPS store, something that's complementary to the use of self-storage would be my guess. And that's what we most often see. We do sometimes see incubator space, where self-storage facilities, and they're really storage units, but they're bigger storage units that may have power and have some amenities, where somebody's, you know, doing some, you know, whatever, some sort of light industrial, very light industrial use, CNC machining or something like that. But typically, I think, David, you hit it right on the head. I mean, it would be a mixed use deal because the municipality is requiring it, which means it's probably very expensive land, infill land, and it's probably in an area where retail is going to be the most likely complementary use.
But
Yeah,
I
that's-
think here, Scott, considering he was with a REIT, and Steve's, we've always thought, okay, you know, up to maybe 10% of the value is okay. The institutional buyers that are looking for self-storage can get their arms around that. When you start getting to the 20%, 30% of, you know, kind of total value of the facility, that starts becoming an issue. Is that about what you think, Scott? Or is that kind of?
Yeah, I mean, we as a company are designed to own and manage self-storage assets. So to the extent you have non-self-storage use incorporated in with that property, you can manage a small amount of it, but the more that you have, the more it takes away from the ability to be able to drive results on the storage side. I think that we certainly have some assets that have more retail and have less retail. I don't think that we target it. And I think that, Kenneth, to your point, you know, the lesser amount, the better. That said, and I think Sean mentioned it, you know, in some cases the municipalities require it, and it's a fortunately and unfortunately a cost of doing business just to have that in there. And it doesn't make operating the property from a self-storage perspective any easier. That's for sure.
It doesn't make financing it any easier either. Lenders don't like it. You start getting into concentration of income. You've got lease rollover, tenant improvements, leasing commissions, things that are, I mean, self-storage is a simple business, and that's what they love about it. It's very repeatable income. Retail is not as repeatable. Retail is more, you know, kind of goes with the economy and also what the latest trends are. So, you know, you're taking something that's very stable and making it unstable, which is not a great thing for the product type.
I would agree with that. Well, with that, I think we're going to wind up and turn the floor back over to the show moderators. And I want to thank you guys to have your level of experience and knowledge shared with everybody is really greatly appreciated, besides being able to see some old friends. So thank you very much for your time today. And
Thank you.
Thanks for
we'll
having
take
us.
it from there.